Okay, hi everybody. In this video, which belongs to the series on IFRS 16 leases, I will be showing how to recognize a lease in the books of the lessee. Now, please note that in all my videos on IFRS 16 leases, the content is equally applicable to the IND AS 116 on leases. Right. So before we go into actually solved examples, we need to understand a few concepts that will help us to solve practical questions on lease accounting. The first two concepts, that is the date of inception and the date of commencement. These concepts I have covered in great detail in my earlier video on identified assets. I will be giving the link to this video in the description. Right. So first we start with the date of inception. It is the earlier of the date of the actual lease agreement or the date on which the principal terms of the lease are agreed to between the parties to the lease. Why is it important for accounting for leases in the lessee's books? This is the date when the lessee assesses whether the contract contains a lease or not. No accounting entries are passed on this date. The second is the date of commencement. Now, this is the date when the underlying asset is actually made available for use by the lessee. This date is important because this is the date when the lessee actually records the lease in his books of accounts for the first time. Now, the third concept is a new one. It is the lease term. So, as all of you may guess, this is the duration for which the asset is made available for use by the lessee. So, although on the face of it, it sounds simple, there are a few complications that you need to know about. Let's understand these with the help of an example. Here, Mr. X leases an equipment for 10 years. He has an option to terminate the lease after 6 years. He also has an option to extend the lease for a period of 3 years. What is the lease term? Is it 10? Is it 6? Is it 3? Now, all of it depends on what Mr. X is reasonably certain to do. Now, let's say Mr. X is reasonably certain to terminate the lease. He is allowed to terminate the lease after 6 years. In this case, the lease period has to be that period where he is not allowed to terminate, and that is 6 years. Now, instead of terminating the lease, let us say that he is reasonably certain not to terminate the lease, but also not to extend the lease. In this case, we cannot consider the additional period of 3 years in the lease term. So, the lease term will be the original 10 years for which he leases the equipment. Now, finally, what if he is reasonably certain to extend the lease? In this case, not only will you take the original lease term of 10 years, you will add the additional 3 years and your lease term is 13 years. Now let's look at the formula. The lease term is the non-cancellable period, the period in which he cannot terminate the lease, in this case 6 years, plus the period where he can terminate, but he is reasonably certain not to terminate, and that is 4 years. And finally, if he is reasonably certain to extend, it is the extension period of 3 years. You will decide whether Mr. X intends to terminate the lease or extend the lease or not do anything about the lease term on the date of the commencement of the lease. Right? Now we go on to the next concept, and that is lease payments. So these are the payments that the lessee makes to the lessor in return for the right to use the asset over the lease term. What are the components of lease payments? The first one is fixed payments less incentives. Fixed payments, they would have agreed something like, okay, I will pay you $50,000 every year. Yeah, so this 50,000 is fixed, therefore it is called a fixed payment. Less incentives, what if the lessor wants to attract the lessee to take up the lease or to extend the lease? In this case, he may give some incentives. These incentives are to be reduced from the lease payments. The next component is variable payments that depend on an index or rate. The index or rate is very important here. This could be any index or rate which is commonly known, like the LIBOR, price of gold, price of oil, etc. It cannot be variable payments that are dependent on the usage of the asset. In case there are such payments, then you will not add it to the recording of lease in the balance sheet. These need to be directly just expensed out. Now, there are certain payments that appear to be variable, but in substance they are fixed. For example, let us say a person is expected to make a payment on the basis of the actual usage of a machine, but there is a minimum payment that needs to be made of 200,000 in a year. In this case, the 200,000 is fixed, irrespective of whether the asset is used or not. So, this is what is known as a variable payment, which is in substance fixed. Those in substance fixed payments also need to be added to the lease payments. The third component is exercise price of a purchase option. If the lessee has an option to purchase the asset and he's reasonably certain to actually purchase the asset, then you will consider the purchase price of the asset. The fourth one is if the lessee is reasonably certain to terminate the lease before the end of the lease term. In those cases, the penalties that he will need to pay on termination of the lease is to be added. And finally, residual value guarantees by the lessee. If the lessee guarantees to the lessor that the asset will have a value of 100,000 at the end of the lease term, this is known as a residual value guarantee that the lessee is making to the lessor. This will also be added in the lease payments. Now you see, all of these added together comes up to the lease liability. Now what is important to note is that most of these payments happen in the future. So you need to discount it to the present value as on the current date when you are recording it in your books of accounts. The rate at which you will be discounting all the future values, cash flows, to compute the present value of your lease liability is known as the discount rate. Now, if you are writing an exam for one of the lucky ones, the rate will be directly given to you. But let's say you need to account for this in real life. How do you calculate the discount rate? Now, the discount rate is the rate that is implicit in the lease. What does this mean? This is the rate at which the present value of all the lease payments plus the unguaranteed residual value is equal to the fair value of the asset plus initial direct cost borne by the lessor. Now, let's say you don't have any of this information, you cannot calculate the implicit rate of interest, then the standard makes it easy for you. You can consider the incremental borrowing rate of the lessee. What is the incremental borrowing rate? That is the rate at which the lessee would be able to borrow an amount to purchase an asset like the underlying asset of the lease for a similar lease term, having a similar security and in a similar economic environment, right? So that is basically the incremental borrowing rate. After the discount rate, the final concept that we need to discuss is the initial direct costs. Now, these are additional costs that are incurred for securing the lease. Now, these initial direct costs will be added by the lessee to the asset value. All right. Finally, let us look at how the lease will appear or will be presented in the financial statements. Now, the entry that gets passed is ROU asset. ROU stands for right of use. Asset debit to lease liability credit. Now, the ROU asset is to be presented on the asset side and the lease liability on the liability side. Generally, the ROU asset would come as a non-current asset and the lease liability will come under long-term liabilities. But of course, if the value is valid only for a period that is less than a year, then it would come under short-term assets and short-term liabilities. The interest and the depreciation relating to this lease is to be expensed out in the income statement after making adjustments to the value of the ROU assets and lease liability. All that I have discussed now will be much clearer to you when we actually solve accounting problems. Right, so this is a very short video where I have only discussed the theoretical concepts behind solving lease accounting problems. In the next video, I will be taking up examples on how to actually recognize and measure a lease in the books of the lessee. So thank you very much for watching this video. I welcome all your comments and thoughts on improving these videos further. I really hope that you found this video helpful. Thank you very much. Bye.